welcome to episode 21 of the Special Situations Report, a podcast by Inside Arbitrage covering the most intriguing event-driven activity over the past week. My name is Asif Suria, and I'm coming to you from the beautiful San Francisco Bay Area.
And my name is Tamanna Suria, and I currently attend the University of California, Los Angeles.
On this podcast, we will discuss the new deal for Informatica by Salesforce, a potential deal for the luxury real estate broker Douglas Elliman, a management change, and a buyback announcement at Maple Bear, which is the parent company of Instacart, a sudden departure at battery storage company EOS Energy, and a whole lot more.
Before we begin, it's important to state that this podcast is for general informational and educational purposes only. The content does not constitute financial, investment, legal, or tax advice. We do not warrant the completeness or accuracy of the content or data provided in this podcast. Nothing discussed in this podcast should be interpreted as a recommendation to buy, sell, or hold any investment or security. Investing involves substantial risks, including the potential loss of principal. You should conduct your own research and due diligence before making any investment decisions.
If you have been enjoying this podcast, do us a huge favor and take a moment to like, subscribe, or rate this podcast on whatever platform you might be listening on.
We'll start our podcast off today with the current deal update, which is that SPAR Group has decided to terminate its merger with Highwire Capital. This was a tiny deal to begin with. SPAR Group, which is a merchandising, marketing, and distribution services business, has a market cap of just $24 million. Highwire Capital, on the other hand, is a large mid-market investment firm focused on technology-backed businesses.
Yeah, this is one of the reasons I tend to stay away from the super tiny deals like this one. This deal had faced multiple hurdles along the way, especially issues related to lending and financing, and the termination date was extended repeatedly from the fourth quarter of 2024 to February, March, and then finally May of this year.
As the lender issues persisted and the deal appeared to be nowhere close to closing, SPAR Group decided this week to terminate the merger with Highwire Capital. Under the terms of the merger agreement, Highwire is required to pay SPAR Group the termination fee of $1.75 million.
Moving on from tiny deals, let's talk about new M&A with very large deals. Salesforce decided to acquire Informatica in a cash deal for $25 per share, worth $8 billion. Informatica is a data management software company, and there was speculation about a potential deal all the way back in April 2024, but talks fizzled after the companies couldn't reach agreement on specific terms.
There was another report from Bloomberg that Salesforce was in talks to acquire Informatica on May 23rd of last month, and the deal was finally confirmed 4 days later. The current spread on the deal is 4.12%, but the annualized spread is just 3.54% because Salesforce expects the deal to close in early of its next fiscal year, which begins in February 2026.
Considering what is going on with the Juniper Networks and HPE deal, where the DOJ has filed to block the deal, I'm a little surprised that the spread on this one is so small. One reason for optimism could be that there is a large number of established and emerging data management companies compared to networking companies like Juniper Networks.
Another new deal that was interesting was the acquisition of the Bermuda-based shipping company Golden Ocean Group, which operates a fleet of 90 dry bulk vessels by Belgian oil tanker company CMB.TECH in an all-stock deal valued at $3.16 billion.
An oil tanker company buying a dry bulk goods shipping company is an interesting choice and not something I would have expected. The companies had signed a term sheet in April proposing a stock-for-stock merger. The deal is expected to close in the third quarter of this year, and the spread on the deal is almost 9%. Considering it's expected to close in a few months, the annualized return is almost 27%, which is very attractive.
To add to the attractiveness of this deal, there is a 5 cents per share dividend that has been declared with an ex-dividend date of this week that boosts the return by a tiny bit. Considering that this is an all-stock deal, it does require shorting the stock of the acquiring company to lock in the spread, and that can lead to issues if arbitrageurs are not careful.
Yeah, I generally tend to avoid all stock deals because if the deal for some reason doesn't go through, you get hit on both sides. One, because the acquiring company's stock might actually go up and the target company's stock might go down at the same time. Let's switch gears to spin-offs. We want to talk about a company that isn't announcing a new spin-off, but a spin-off that had occurred a few years ago that is actually getting a potential offer from a company. Over the last couple of years, I've discussed the luxury real estate brokerage company Douglas Elliman with investors both in person and through email exchanges. The company was spun out of Vector Group towards the end of 2021, and both the parent and the spin-off have headed in very different directions. While the Vector Group is up more than 50% since the spin-off, Douglas Elliman at one point was down more than 90% due to a weak environment for existing home sales in a high interest rate environment. This environment was one of the reasons I stayed away from the company because while new home builders were doing very well, anybody who was servicing existing homes wasn't doing quite so well.
Investors got some welcome news last week when Bloomberg reported that Anywhere Real Estate, formerly known as Reology, approached Douglas Elliman with a bid that would value it at more than $4 per share. Douglas Elliman's stock, which had nearly doubled from a low of close to $1 last June, surged even more after the news and currently trades at $2.72 per share.
It was interesting to see that a cluster of Douglas Elliman insiders had purchased shares close to those lows last July, but then again, they've been active buyers pretty much all the way down. And so this was a company that made it into a SpinSider screen, which looks at spin-offs with insider buying.
And it isn't quite clear if the company will accept the speculated $4 per share bid from Anywhere Real Estate or push for a higher price. Even if the final deal is struck at the $4 per share price, there is still significant upside from current levels.
Let's see how this whole situation plays out. Moving on to stock buyback announcements, Brookfield Corporation, an alternative asset manager out of Canada, and an investment firm that's focused on multiple areas, including real estate, renewable power, infrastructure, and more, just announced an $8.17 billion buyback, representing 10% of the public float of Brookfield's Class A shares in circulation. Due to how the company is listed, the buyback will be executed on the open market via the TSX, NYSE, and other trading systems. Brookfield, as you probably remember me discussing in the past, is often considered to be like the next Fairfax or the next Berkshire Hathaway. And the company is structured in a very complex way with multiple subsidiaries, and Brookfield owns different portions of these subsidiaries. The buyback comes at an interesting time, especially considering that Brookfield stock is up 32% in the last year and up over 123% over the last 5 years.
Moving on to another interesting buyback that we saw, Maple Bear, which is the parent company of Instacart, just announced an additional $250 million authorization to their previously announced share repurchase program, authorizing the purchase of up to an aggregate of $1 billion of the company's common stock, up from the $750 million authorized by the board in June 2024 and November 2024 collectively. Approximately $218 million of capacity was remaining under the existing share repurchase program as of March 31st, 2025, and then the $250 million announced this week adds to that value.
Yeah, I don't understand why this company just doesn't call themselves Instacart instead of using the name Maple Bear. Maybe it's one of those Alphabet and Google kind of things. They figure they'll at one point become a holding company for multiple brands. But right now, I think the stock would do better if they were just called Instacart instead of this strange name that nobody is familiar with. Instacart went public a little over a year ago and is up 35% since its IPO and up 47% in the last year alone. The company was a beloved startup unicorn, and its IPO surprised some investors as the pricing of the IPO gave Instacart a market value of around $10 billion, far lower than the $39 billion valuation it had after a fundraising round in 2021. So that's quite a decline in valuation between what the private market was valuing it at and where it ended up on the public markets.
I will say that Instacart IPO was one of the first technology company IPOs in quite some time. So it kind of ended a drought in some sense. That's kind of what the IPO was heralded as. But it was a very, very sharp drop in valuation, as we saw in startups across the board, right? From 2021 to when they eventually went public in the more recent years. The
Indeed.
prices have dropped significantly. But moving back to the company, Instacart as it stands today, this week they also announced the appointment of Chris Rogers as the company's new CEO. He currently serves as Instacart's chief business officer, overseeing all aspects of the company's commercial operations, a role he's been in since July 2019. Mr. Rogers also previously served as the managing director for Apple Canada, a company he was with for 11 years.
The C-suite transition comes shortly after the announcement that OpenAI had recruited Instacart's current CEO, Fidji Simo, and I hope I didn't mess that name up, to be its new CEO of applications. She joined Instacart's board in January 2021 and took over the role of CEO in July of the same year and was instrumental in taking the company public. After her departure, she will remain on Instacart's board as chair, in addition to serving on the boards of OpenAI and Spotify.
Instacart did take a major hit in late February of this year, dropping over 12% in a single day, after the release of disappointing fourth quarter results and a lower than expected earnings forecast for the upcoming quarter. However, the stock has rebounded since. The company currently trades at a PE of around 30, which appears expensive but at the same time is very typical of businesses in this industry.
I can't imagine her departure is going to be looked at as positively by Instacart investors, and I can see this stock remaining under some pressure until investors get comfortable with this new CEO, which is an internal promotion instead of somebody coming in from outside to turn around the company, which doesn't seem to be the case here. It doesn't look like it needs a turnaround. But she was certainly somebody who was well respected in the industry, and this is quite a loss for the company. Switching to insiders, this week we saw director Robert Peace buy shares of Phillips 66. The purchase was small, only worth about $50,000, but it stood out to us due to who Robert Peace is. In one of our early episodes, we talked about Elliott management taking an activist position in Phillips 66, expressing his displeasure with Phillips' underperformance compared to its peers, its loss of focus on its primary business of refining, and failed attempts to reduce operating expenses.
Elliott had a list of demands for the company, encouraging Phillips 66 to spin off any non-core business operations, including their midstream business, which Elliott values at over $40 billion. Elliott is also encouraging Phillips to sell off its joint 50% stake in CPChem, an R&D energy resource initiative it shares with Chevron. Lastly, Elliott is emphasizing the frequently discussed sale of Phillips' jet retail operations in Germany and Austria, and states that they should actually be executed.
As is typical of the Elliott playbook, the company also asked the management team and board to be completely refreshed, which Phillips 66 was less open to, and hence a period of hostility between the two companies began. Robert Peace's purchase was especially fascinating to us because he was appointed to Phillips' board of directors in 2024 as a result of an agreement with Elliott.
So when we saw Mr. Peace buying shares, we figured this was another way for Elliott to reassert control over Phillips 66. But we noted that instead of buying shares indirectly via Elliott, what stood out to us was that Mr. Peace was buying shares directly under his own account. Little did we know that there was so much more to this story. I found a letter from late March of this year, written by Mr. Peace, where he detailed his support for Phillips 66 rather than Elliott in the current battle between the activists and the company. He noted that Elliott wanted him off the board, having put him on the board just over a year ago, and that the activist firm had been incredibly uncommunicative over the last couple months, and reiterated his faith in the current Phillips 66 board rather than supporting Elliott's ongoing campaign for change at the company. So we almost have a rogue Elliott director situation going on at Phillips 66 right now.
That's highly unusual and something that Paul Singer and the team at Elliott probably did not anticipate. Although I do hear that the person at Elliott who's in charge of the energy division is highly experienced and very well respected in the industry. So let's see how this whole thing plays out. I mean, this whole thing sounds very similar to what Elliott is doing with Honeywell, asking them to break up into its different component parts. And, an integrated oil company these days is rarer than a company that has just exploration and production or just midstream or just downstream retail operations. So I can see why Elliott wants this to happen, but it'll be interesting to see how and when this whole thing plays out. Switching gears finally to C-suite transitions, EOS Energy Enterprises, which designs, manufactures, and deploys battery storage solutions for utility, commercial, and industrial markets, just appointed its current Chief Commercial Officer and former CFO, Nathan Croker, as his interim Chief Financial Officer, while a search for a permanent CFO is underway. EOS has terminated the employment of its Chief Financial Officer, Eric Javidi, on May 27th, effective immediately with no explanation provided.
Mr. Javidi had just joined the company in March of this year, after serving as the CFO of Archaea Energy, the largest renewable natural gas producer in the U.S. that was acquired by BP in late 2022. To see such a sudden termination just a few months after Mr. Javidi had joined the company brings up some interesting questions about what's been going on at EOS Energy Enterprises, but it's unclear if we'll get any additional details on this sudden termination in the next few days or weeks. And that wraps up episode 21 of the Special Situations Report. We had a bit of a shorter episode this week, but what we've covered today, as always, is just a brief overview of the special situations landscape. So if you'd like to access a more comprehensive weekly overview of all special situations activity, go ahead and visit our website, thespecialsituationsreport.com. For daily updates and alerts on the event-driven world, as well as access to tools to help you identify opportunities, such as the merger arbitrage tool, check out insidearbitrage.com.
And if you enjoyed this very short podcast today, please take a moment to like and subscribe on whatever platform you may be listening on, and especially share it with your friends who are interested in special situations. Thank you.